we are purely looking at real estate as an investment instrument. Okay. So with that in mind, Karan, I want to jump straight into the first question, and that is treating real estate as an investment asset class, right? How should it feature in somebody's overall investment portfolio?
See, if it comes to investment portfolio, real estate is like gold.
Okay.
Okay. So in general, if you look at the global trends in asset allocation, real estate is typically allocated 10% of overall portfolio.
Okay.
Okay.
Mhm.
And it's supposed to provide alternate beta to investors, kind of, risk diversification.
Right.
Okay. So like gold, it also provides inflation hedge.
Mhm.
Okay. So let me give you an example. Typically, people link real estate to the state of the economy. Okay. In the market.
Mm.
Okay. So in general, when market and economy are not doing well, real estate should actually go down.
Correct.
But if you look at even in our country, okay, our own country, from 10 to 14, my stock market return was zero. Economy was wobbling.
Mm.
Okay. Inflation was double digit, around 10% on an average. Okay. We were basically included in notorious grouping of fragile five.
Mm.
Real estate prices across the board became double.
Because do you think that happens because people tend to start looking at investment in real estate at such times as a safe haven?
See, the thing is, when the inflation is around 10%,
Mm.
so you need 12% to make some real returns. After adjustment
Correct.
for taxes, you
Correct.
need 12%. So when stock markets are not performing,
Mm.
okay, so people start looking for alternate vehicles.
Right.
Okay, so real estate was beneficiary of it. Basically came up as an alternate, and it was not like people were buying in big cities. Okay,
Mhm.
only in Gurgaon or Bangalore or Delhi or Mumbai. They were going to far-flung areas, tier 2, tier 3. Ticket size also came down to make it affordable. That was also one reason behind the real estate boom. Okay, so earlier, in cities like Delhi, Mumbai, you need in Mumbai you need 2
Yeah.
3 crore, 4 crore in those days.
Correct.
Okay, in Delhi typically you can get the property of 1.5 crore.
Mm.
Okay, 2 crore. In Gurgaon it was same rate.
Yeah.
Okay, but if you go, let's say, in some tier 2 cities of Rajasthan
Mm.
or Uttar Pradesh, just 100 kilometers from Delhi, you can get the 2 BHK, 3 BHK for 30, 40. You can book it for 30, 40 lakhs.
Mm.
Okay. So
It was more within reach.
so it started with the suboptimal returns from stock market, combined effect of inflation and suboptimal returns from stock market.
Mhm.
And then it became the function of ticket size as well.
Right.
Okay.
Right.
So more and more money started to flow into real estate.
Mm.
Okay.
Mm.
So, and real estate cycle is quite long.
Correct.
Okay, so
Correct.
it's not like 1 year, 2 year, 5 year. If you're going to be if you're going for real estate, you are going for a minimum 10-year cycle,
But even as an investment instrument,
even as an investment instrument.
because there is this whole idea of flipping houses also, right?
Mhm.
Like if I look at a good potential real estate market, I invest in a good under construction thing, and maybe in 3-4 years when it is ready, then you try and flip the house for a better appreciation.
The first question is whether under construction thing would be delivered to
Right.
you on time. Okay. Second thing is that most of the people buy the house when housing market is at peak.
Right.
Okay.
Right.
So opportunity cost plays on the mind. Okay, I've seen this property some 3 years ago. Okay,
Right.
now it is appreciated by 50%. I will not make the same mistake again.
Hmm.
And you go for that. But I have seen in 12, 13, most of the people who bought house at that time remain stuck in that property for 10 years.
Because they were not getting the kind of appreciation that they expected.
It was not about that. They booked booked the apartment in 2012, 13.
Okay.
Okay. They got the apartment in 16.
Hmm.
Okay. And real estate market was stagnant after that. Okay. So for 5 years, they remained there.
Hmm.
And many of those properties were bought on loan. Okay. So they were paying EMIs as well, interest. They remain stuck there for 10 years. So real estate cycles are quite long. They're not like equity markets. Okay. So in US, they say that real estate bull market was lasted for nearly 100 years. Okay. From 1905 to 2005.
Right.
And then the bear market lasted for nearly 12 years.
Right.
Okay. So as country become developed, as income levels increase, the cycles would become even longer. So if you are thinking about with the perspective of quick returns, quick bucks, there is a chance that you might be successful in one or two attempts, but in third attempts you will remain stuck for next 15 years.
Because that is the nature of that asset class, right?
Yeah.
That is how the entire thing is.
Yes, it is driven by multiple factors. What is the inflation? What is the demand in the area? A lot of factors come into play.
And plus the ticket size itself, which is not as good. Which is never going to be
liquidity
as
is always a problem.
Yeah.
Interest rates, if they are rising, that's an issue. If economy is in distress, then also it's an issue. A lot of factors which are out there, which you will not find with the normal mutual fund and stock investment.
Right. What is the kind of correlation that real estate as an investment instrument has with other traditional investment instruments? Like, is there a direct or indirect correlation, both positive or negative, in your opinion, or what you have seen?
See, correlation is quite low. More often it's negative.
Okay.
In general. Okay. Gold and real estate to an extent move together.
Right.
Okay. In general, trends move together. Problem with gold is a sought after asset during times of economic distress.
Right.
Okay.
Right.
And real estate is typically with the high ticket size and utility of that particular property dependent on economic development in the area. Okay. They basically saw price depreciation during those phases in case of economic distress. So at times it's positive, at times it's negative. Okay. But it's low only.
It is low compared to the other traditional
and unlike
instruments.
Gold and stock prices, property is not quoted every day.
Yeah.
Okay. It's a yearly trend or maybe at best a quarterly trend you can get. Okay. They are not quoted every day. Okay. Right. Second, when it comes to equities in general, in equities, when in the times of economic upswing, when the interest rates are low, okay, at that time they correlate with equities.
Right.
Okay. Correlation might spike as well in some cases. Okay. But in times of when interest rates start rising, in times of rising interest rates, this correlation go away.
Right.
It dissipate to zero, and in some cases, in the last stages of high interest rates, just before the economic crisis, it becomes negative.
Okay. So just trying to understand this asset class a little more in depth by using, let's say, an example. Like, if somebody has an overall investment portfolio across all asset classes, say around 4 to 5 crores, right? What, according to you, would be, and given that they probably already live in their house, so it's not like they're looking at investment as a way to live there. What should real estate, or how much should real estate be part of someone having a 4 to 5 crore investment portfolio?
Generally, it should start with 5%.
5%.
5%, and you can start with REITs. Okay.
Right.
So there are a lot of options these days. So you have some standard REITs which are listed, which are covering commercial property. Okay. Then there are SM REITs, fractional real estate. Right. Most of the fractional real estate is now regulated by SEBI. Yeah. They're covered by SEBI, and they're forced to list as SM REITs. Right. So you should go with fractional ownership. Okay. Right. So risk is diversified there among different investors. There is an entity which is doing due diligence on the property and everything. Basically, reduce your downside risk to some extent.
Right. So in a way, it allows you the luxury of investing in real estate with the same bells and whistles of a traditional investment.
Yes. Right. And gradually you can increase the ticket size. Your portfolio would expand. You can increase the ticket size, take it from 5% to 10%. Okay. And go through one cycle.
Right.
Go through one cycle of 5-10 years. Okay. See, identify which are the factors which govern a real estate investment. Okay.
Right.
What are the trends? What are the factors? Okay. And then go for high risk on your own. You can go for independent houses, villas, or any commercial property. You can go there. Basically, two things have to be factored in. Okay. When you're going for, especially for residential real estate as investment.
Right.
People often go for rental yields. Don't go for rental yields.
Okay.
Don't go for them.
Okay.
You should go for two things just. So one thing is quality of life.
Okay.
Wherever you are buying the property, quality of life has to be there. Okay. Quality of life, I mean schools, hospitals, cinema halls, basic services that you call same standard of living that you expect in a standard city,
Right.
Delhi, Mumbai, Bangalore, that has to be available. Okay. So, and the second thing is that there should be employment opportunities or scope of employment opportunities going forward.
Okay.
So you can say like some 30 years ago, 20 years ago, Gurgaon was there, 25 years ago. Okay. It was just upcoming at that point of time. Okay. IT industry was just started. DLF was just developing it. Okay. I still remember in Delhi, the buses used to go to Gurgaon. They used to offer free bus rides to prospective buyers, to basically for them to basically screen the properties and everything. Okay. So, but there has to be some scope of employment that has to be there. Either it should have an industrial base, that place already industrial base is there, and they have to migrate to services, or government has some plans, some smart city plans, which are there.
In a way automatically even takes care of your rental yield problem anyways, because if all these things exist, then chances are you will get a better rental yield.
So these are the two things, two parameters on which a property has to be evaluated. If you are thinking about making investment in real estate, these are the two parameters, okay, on which it has to be evaluated. Okay. Apart from that, try to go for apartments, gated communities. Okay, again the risk is diversified.
Right.
A single builder is there, which are covered under RERA and everything. Try to get property where you have regular access. Okay, you can visit it. You can visit the property.
Right.
Okay, unless you have a strong family presence in that particular area or some political connections, don't go for plots or empty lands. Okay,
it's very difficult to
manage. Very difficult, and in case of lands, regulations also change sometimes with time, which can put your investment in problem.
Right.
So these are some parameters that need to be looked into, okay, before deciding on real estate.
Okay, so now when it comes to your rebalancing, which is how we usually talk about when we talk about a traditional standard investment portfolio, right? We rebalance stocks, mutual funds, and all of those things. Where does rebalancing of a real estate portfolio, or how does that really play out?
So basically, what is the purpose of rebalancing? We have to understand. So generally, you have a portfolio that provides 10% exposure to real estate. Okay, let's say. So this is the risk that you are ready to take with real estate.
Correct.
Okay. So let's say now the portfolio has not moved a bit, and real estate has become double. Okay. So it's now 20 out of 110. Okay. So your exposure is around 20%. Okay. Roughly around 18 to 19%. So in this case, you have to reduce the exposure to 10%. Okay. You have to reduce the exposure to 10%, or you have to diversify that exposure in real estate. There are two ways of looking at it.
Correct.
Okay. So you have a property you bought for 1 crore, it has become 2 crore. So one thing is either you reduce it to 1 crore, you sell the property,
buy another
book
one
the
for
gains, and buy one property that is of 1 crore, or you go for smaller property.
Right.
Okay. Or the second thing is you buy two properties. Okay. One thing you have to understand. So when you are selling a property, it is subject to capital gain taxation.
Right.
Okay. And you have to invest within
1 year.
Ideally, 1 year is allowed, but ideally you should 2 years is allowed. But ideally you should try within 6 months. Okay. Otherwise you will be missing out on appreciation. Real estate has a very erratic return profile.
Right.
It might remain the same for 5 months, and then you can see 100% appreciation in 1 year. Okay. So ideally you should already screen out the property that you're going to buy.
Correct.
Okay. And gains always have to go back into real estate. Otherwise you have to pay taxes.
Correct.
Okay. Gains always have to go back to real estate.
So in terms of rebalancing, you're saying, again, there are two ways to do it. One is either you keep your the allocation within your overall investment portfolio at the same level, or even if that is increasing, at least try to diversify that risk.
Yes.
Right. So if that thing has appreciated, then maybe try and diversify into another asset class, like maybe
you can diversify across locations.
Right.
You can diversify across times. Types of the property, residential, maybe some commercial.
Right.
Okay.
Right.
But all properties have to be subject to certain parameters that I already mentioned.
Right.
That have to be there.
Okay. So now the biggest, I think, the factor when it comes to real estate, apart from the fact that it involves a very...
And one aspect we are missing in real estate, there is a rental yield as well.
Right.
Okay. You get some income back in your pocket, typically 3% of your investment that you can get back, and you get somewhere around 30% standard deduction on that.
Right. So that also kind of adds another variable to
some
your
income
portfolio.
stream. So basically, it's kind of a part of your monthly income stream.
Right.
Apart from the salary.
So now the final aspect which I want to stress upon here is that there are two things that sizably differ or make real estate as an investment different from the typical traditional asset classes, and that is, one, the ticket size is quite big, right? It usually is not like buying a stock or investing in a mutual fund. It usually is in the tens of lakhs, if not crores. The second is the fact that it is also highly illiquid compared to every other asset class, right? Are there certain rules of thumb that one should keep in mind, given that these peculiarities exist in real estate as an asset class, when it comes to adding real estate to your overall investment portfolio?
When you're starting with real estate investments, I would always suggest that go with REITs. There are multiple options which are there. Residential properties are there. Commercial properties are there. Okay, decent dividend yields are also on offer. You can go with some reputed properties as well, reputed builders as well. Start with that. Diversify it across 10, 15, 20 properties. Okay, go with that. Take a diversified exposure and continue with that for some time. Okay. So once you find an opportunity, let's say somewhere at a discount, at a deep discount, you find an investment opportunity which you feel that can provide you abnormal returns. Okay. Again, it has to be evaluated on the parameters like of quality of life, okay, or potential quality of life.
Right.
Okay. You can say possibility of possibility of the city becoming an employment hub. Okay, employment opportunities have to be there. Okay, how is the overall local governance is there? Okay, if you're buying a property, what is the track record of builder? Okay, would the project get completed on time? Okay, what are the legal recourse that is available if things don't go your way? Right. Of somebody squatting on your property, okay, or builder is not completing on time. So if you're looking at all these parameters, you identify one property, you can go for that. But I would still suggest that start taking experience. It's like when you're starting the equity journey, you start with mutual funds. Okay, don't go directly for equities, right?
Correct.
You start with mutual funds, you understand the market, or you understand the basic nuances. Okay, what are different cycles? After some time, you gather courage to go into equities directly.
Right.
So it's the same way with real estate. And real estate, because the ticket size is very high, it's illiquid. And if you are stuck in bad place, you can lose 100% investment.
Right.
That risk is always there. Okay. In equities, there is a chance if you enter bad time, you will lose 20-30%. Okay, and you might still be able to take out money and live for the day.
Right.
In real estate, you will lose everything if you make a wrong investment. So it's even more important in case of real estate to start with that. And I would say that if you have some corpus of 100 crore and you started with 10 crore, yes, you can definitely diversify yourself across 8 to 10 properties. Okay, that will reduce your risk. But I think most of the upper middle class people right now in early 40s, they are starting with 5-10 crore corpus. In 1 crore, it's not possible to diversify. And I think in normal salary, if you talk about the normal salary class, we will never have a scenario where they have 15 crore to invest in real estate. Okay, so you will never reach that scenario.
That's why
you might never reach that scenario that you would have a chance to diversify across 5-6 different properties.
And that is why instruments like REITs and these things are a much better in.
You start with REITs. Okay, that will give you an average of real estate returns that would be there. And after 5-6 years or 10 years, if you find some abnormal return opportunity, then you can go for that.
Got it.
But that has to be you have to have conviction about that, because your entire real estate slice would be locked there.
Right.
And if that project fails and that thing fails, entire money would be gone. Entire money would be
locked.
You will never get that money back.
Right.
You will have an asset on your name, but it will nothing.
Okay, fair enough. So I really hope that gave some sort of an insight into how investment in real estate as a instrument and not as a living option really plays out. Once again, thanks a lot, Karan.
Thanks, Santosh.
See you soon.